một trang lãng du, cứ vài lá thư tình đẹp đáng mơ. Hơn 2 năm xa nhăm quen chàng trai phố tưởng chừng thiết tha quay cùng bơ vơ. Không cam tâm anh nghĩ đến lúc để mình đến nơi bên em và lắng lo cho em. Những ngày khi anh hy vọng nhớ thì mọi thứ lại hóa cho tan, vì anh biết nơi đã có thêm một người khác đã chiếm lấy trái tim em rồi. Vì anh biết nơi đã có thêm một người khác đã chiếm lấy trái tim em rồi. Em bay trên mây trong thêm ngoái sau, mặt người dõi theo lòng buồn hắt hiu. Khi mưa rơi mây tan đêm lững lờ chốn nào, niềm đau xé cao trái dần tí níu. Anh thương em nhưng bao nhiêu lâu càng chìm đắm vô sâu hơn, càng thấy thêm cô đơn. Sau lưng em và anh níu giữ toàn là hão huyền, yeah. Vì anh biết nơi đã có thêm một người khác đến sau đã chiếm lấy trái tim em rồi và mãi xa xôi. Vì anh biết nơi đó có thêm một người khác, không phải anh đã chiếm lấy trái tim em rồi. Để anh chơi vơi, anh hy sinh nhưng không thể mãi là một người vô hình nơi phía sau em. Đáng lẽ rồi nên nhắm mắt buông đi tất cả để bản thân mình thôi đớn đau thêm. Nhưng anh giang tay ôm nỗi nhớ, chấp nhận muốn nó xót xa. Vì em đã chờ rất lâu, rất vì anh biết đây có thêm một người khác đến sau đã chiếm lấy trái tim em rồi và mãi xa xôi. Vì anh biết đây đã có thêm một người khác, không phải anh đã chiếm lấy trái tim em rồi. Để anh chơi vơi, vì anh biết đây đã có thêm một người.
Các bạn không cần nỗ lực trong từng sản phẩm organic. Một cơ bờ có organic, nguyên liệu chuẩn organic, một cốc có organic, trải qua hơn 100 lần kiểm tra. Organic thật sao? Không chỉ organic, đó là cơ bờ organic.
Number one chân rất sảng khoái, number one dâu uống vào sảng khoái, bật tung năng lượng, xuất phát. Thiếu sức mạnh bứt phá.
Chịu rồi.
Cạn kiệt năng lượng.
Bỏ cuộc thôi.
Đừng lo. Hãy uống nước tăng lực number one chân rất sảng khoái, nước tăng lực number one dâu uống vào sảng khoái, bật tung năng lượng. 1, 2, 3, let's go. Sức mạnh bứt phá, năng lượng dài lâu không anh khắp không tưởng chiến thắng mọi thử thách rồi. Nước tăng lực number one chân dâu uống vào sảng khoái, bật tung năng lượng.
Cho con cánh mẹ một lần, cả đời mẹ đã tạo thành cánh con. Cho con cánh mẹ đau đớn, cả lòng mẹ đã cánh con biển trời. Ngày xưa mẹ cánh ơi, con xin cánh lại những lời mẹ xuống đường đời sương gió mịt mù, vì con hạnh phúc chẳng từ gian nan. Để con gánh mẹ đừng gánh, giờ khi mẹ mất buồn bã gánh ai cho con, gánh cả tháng dài, gánh qua năm dòng những ngày đắng cay. Cho con gánh cả đôi vai, thân cò làng lội sớm mai phải gầy. Mẹ già lá sắp xa cây, nở đâu lá rụng tuổi này gánh xa ao. Mẹ ơi sông biến ra sao, con sao gánh hết công lao một đời. Bông hồng cài áo đúng nơi, đâu bằng bông hiếu giữa trời bao la. Cho con gánh lại mẹ già, để sau người gánh chính là con. Cho con gánh mẹ một lần, cả đời mẹ đã tạo tần gánh con. Cho con gánh mẹ đau đớn, cả lòng mẹ đã gánh con biết trời. Ngày xưa mẹ gánh ơi, con xin gánh lại những lời mẹ ru. Đường đời sương gió mịt mù, vì con hạnh phúc chẳng từ gian nan. Để con gánh mẹ đừng gánh, giờ khi mẹ mất một bà gánh ai cho con, gánh cả tháng dài, gánh qua năm dòng những ngày đắng cay. Cho con gánh cả đôi vai, thân cò làng lội sớm mai phải gầy. Mẹ già lá sắp xa cây, ở đâu lá rụng tuổi này gánh xa ao. Mẹ ơi sông biến ra sao, con sao gánh hết công lao một đời. Bông hồng cài áo đúng nơi, đâu bằng bông hiếu giữa trời bao la. Cho con gánh lại mẹ già, để sau người gánh chính là con. Cho con gánh cả đôi vai, thân cò làng lội sớm mai phải gầy. Mẹ già lá sắp xa cây, ở đâu lá rụng tuổi này gánh xa ao. Mẹ ơi sông biến ra sao, con sao gánh hết công lao một đời. Bông hồng cài áo đúng nơi, đâu bằng bông hiếu giữa trời bao la. Cho con gánh lại mẹ già, để sau người gánh chính là con. Để sau người gánh chính là con. quá khứ nhớ lắm khi anh về trả lời anh yêu thương ấy xin lời hãy về nơi đây bắt tay yêu ớt có níu em ở lại rồi mà anh sẽ anh biết phải làm sao yêu trong em đêm nay ai dần đi theo gió bay còn lại chỉ nơi đây cô đơn riêng em đi xa quá em đi xa có biết không nơi đây anh vẫn đứng đợi một giấc mơ chờ đợi một cơn mưa sẽ xa xinh giấc mơ trong đêm mơ anh. Okay, good morning, everyone. Sorry, I had to mute the music. Thank you for the music. Now it's 7 p.m. for you guys, so it's time for us to work. Just somebody can confirm in the chat that you can hear me and see me. Morning me. Morning Ken. So you can hear me, right? Okay, perfect. Thank you very much. Good evening, everyone. I hope you are okay. Thank you, Luang. So we are. So it's recording. So everything seems to be ready. So we can move on. And so today we're gonna work on investment rules and capital budgeting. Hi, Chang. Okay, so according to my plan, I think we will not be totally finished today. So we're gonna need maybe one more hour tomorrow, I guess. Then we will move into groups. So that would mean that Friday and Saturday, I would give one more hour to finish to prepare the group work. Okay, it's just for you to know. I don't know yet. We need to wait to to keep on going, but we are on track. Huh? It's exactly the same thing than the previous years. So that's why I decided to make 2 groups Friday, Saturday. So we have only 4 presentations. So I think it's okay. There is no problem. So the thing is we have to move on to the next topic. So we were discussing the investment decision rules, and so we were discussing the payback rule yesterday, and so we were calculating the payback rule for Frederick project, okay, and we said it's okay, but not so much, because we do not take into account the interest rate, the discount rate, the time value of money. Okay, and the second thing, which is less important, but still, since your manager says to you, I will accept only projects that pay back in 5 years or less, so you forget all the cash flows after the year 5. Okay, so it means that if you have a project for which you don't have a lot of cash flows the first years, but then suddenly you have big cash flows after 5 years, of course, it's gonna influence negatively your decision. But again, what is the most important thing is, in the normal payback calculation, we do not take into account time value of money, because we don't discount the cash flow. So it's not satisfactory. And so we finished yesterday saying that maybe we could try to calculate the the time value of money, the payback period, but taking into account the discounting aspect. So I said, okay, let's consider that we have a project for which we have an investment of 250 at the year 0, and as you remember, maybe hopefully there is a positive cash flow every year forever, 35. And so I just added the assumption that we discount the cash flows at a 10% level. Okay, and so finally what we had to solve was to calculate the N, in the equality where the NPV is equal to 0. So the NPV is equal to 0 when the cost equal to the benefit. So this is the moment when we pay back, right? And it's the moment when the NPV happens. And so we need to solve n in this equation. So I don't know, because I asked you to calculate this, is there some of you guys in the chat who took the chance to try to calculate n in this scenario? So if you have, please, can you share the answer before I show the official solution? So this one is called the discounted payback period, right? Because this time we take the time value of money. So this one is as acceptable, right? The payback period, you can still calculate it, but it's not satisfactory. So in that case, we found 7 years, right? Oh, I lost my formatting because I moved to maybe you can see I moved to the to Excel in English, but then I lost my okay, that's correct. Okay, and so now, okay, so now it's dot instead of comma. Okay, so it should be okay. Anyway, so okay, so no answer in the chat. So I assume that maybe yes, that's correct. Hung, that's correct. Anne, yes, you are both correct. This is 13.14 years. 13.14 years. That's correct. Okay, so I just detailed here, and of course, as usual, at the end of the class, I will put my Excel Blackboard on Canvas, right? But so here it's like I took the time yesterday to write down like I would do on a board, right? So if this one is equal to 0, then you know I redistribute my equality, okay, to finally reach something when I have on one side of the equality 1.1 exponent n, and on the other side of the equality I have so a constant, which is in this case 3.5, and so using the logarithm like you can see here, okay, I find 13.14 years. That's correct. Okay, so it means that if we use a 10%, we need 13 years to pay back the project. Okay, so it sounds a little bit long, but still, we don't care. What we want, we care about for the moment is to be able to calculate it. Okay. So this is something you can do also for your group work to calculate the discounted payback period, or at least the payback period, okay? But the two most important investment rules are the NPV and the IRR, okay? So these are the two ones that certainly will be important to calculate. Okay, so that's for the discounted payback period, which is not in the book. So you will not find that in the book. It's just something I added, because this is something we can use in real life. Okay, so we discussed the investment decision rule. So NPV, IRR, payback period. Okay, and all those things we studied them in the context of standalone projects. So we just have one project, and we just have to find if we undertake the project or not. Okay. So now let's talk about the situation when we have to choose between projects. Of course, we can also use the same indicators that we discussed. And so how do we do that then? So when you must choose only one project among several possible projects, the choice is mutually exclusive. You take one or the other, okay? And so, of course, if you go with the NPV rule, theoretically, you will take the one with the highest NPV, okay? Project with the highest NPV. Or if you take the IRR rule, you will take the project with the higher IRR. But be careful, it can lead to mistakes. Okay, so we're gonna make an example about this, but I mean, it may lead to mistakes, but for me, it's not so bad to have the two of them. Um, I'm gonna explain why, because you know, as I said yesterday, of course, if the project need a higher budget at the first place, of course, maybe the NPV will be higher, but proportionally, you know, maybe not. Maybe the IRR is better. So it depends on different things. So we're gonna illustrate that with this example. So just for I would need a confirmation from you guys. So you have this example, which is from the book, and then you have the solution. Usually you have the solution because I don't want us to calculate here. I just want us to discuss. So can you confirm that I did not forget to give you the solution? Do you have the solution? Yes, okay, perfect, thank you. Okay, so we can look at the data and then we discuss the solution. Okay, so it's an interesting example. It's quite pedagogical, I guess. So you got a small commercial property which is for sale near your university or in Hanoi or in Ho Chi Minh City. Okay, given its location, you believe that a student-oriented business would be very successful here. Yeah, for cold, you know, for iced coffee or for iced tea or for something else, or for food or whatever. And so you have researched several possibilities and come up with the following cash flow estimates, including the cost of purchasing the property. Which investment should you choose? And then finally, you have been thinking about 4 different projects: a bookstore, a coffee shop, a music store, and electronic store. Okay. So here you have the data about the initial investment, okay? So we can see that the bookstore needs less investment and the 3 other are identical, okay? So I would say that when we calculate the NPV, for the 3 last ones, it will be fair, it will be okay to compare the NPV without, you know, further thinking because the investment is the same. If we talk about the bookstore, we have to be careful because the bookstore has less initial investment. Okay, so it means that maybe the NPV will be higher in value. Okay, but it doesn't mean that the opportunity is not good. So we must also calculate the IRR. So for all the shops, we have some assumptions about the first year cash flow. Okay, 63, 80, 104, 100. And you're going to see in the solution that we consider that it's a growing perpetuity that we're going to calculate. So we have a growth rate and we have a cost of capital. Okay, so you can see that each time in the example, it's made on purpose. You have three stores which have identical assumption and one which has a different one. So for the growth rate, for example, we can see that we have a reasonable assumption for 3% for the growth rate for everyone, except for the music store, which makes sense because maybe music is not the business of the future. Even if your colleague was sharing with us an excellent music just before the course, music is not something people buy so much physically now, you know, so it's more like digital. So of course, yes, maybe it's not a business of the future. So that's why maybe it's reasonable to take a growth rate which is equal to 0. About the cost of capital. Cost of capital is the discount rate we will use to discount the cash flows. So if you remember well, I'm sorry, I don't remember the name of the student who asked me about the risk premium 2 days ago, 3 days ago. And it was very interesting to discuss this topic because of course, we were introducing in the interest rate chapter, the risk, right? And so how do we take into account the risk? Well, we take into account the risk in the discount rate, okay? So here we can see that we have 3 stores for which it seems that the level of risk is the same. And we get one for which it seems that the risk is higher for electronic store. So I don't know why, maybe because we can, I don't know, we have obsolescence, for example. You know, if you don't sell your electronics the first year, maybe it's too late the second year because you know, it's old-fashioned already, so you know, that kind of thing. So it seems that this business is more risky. Okay, so that's very interesting because, you know, you don't do the calculations now, right? You are just reading and listening to me. So you're really in the position where you would be a manager or the potential investor in this case. You know, you would be the one who opened the business, so you would think about this assumption. So it's good, hopefully, that now you may be more comfortable with the corporate finance topics, time value of money, because you can see how it can be useful for you to take a decision. So let's have a look at the NPV, which is calculated in all the cases. So as I said, it's growing perpetuity for everyone, but except for this one, because we know that growth rate is equal to 0. So it's 8% minus 0, but you know, it's at least a perpetuity. And so we calculate the NPV. Okay, so firstly, as you can see in the solution, all the alternatives have a positive NPV. Okay, so but because we can only choose one, the coffee shop is the best alternative because it's the highest NPV. Okay, it's interesting the way it's written. All the alternatives have a positive NPV. So if I was working in an auditing firm and I would give advice to the person who would like to open the business, the first thing I would say to this person or to this group of people is to say, okay, whatever the business you're opening, it seems that the NPV is positive. Okay, so firstly, it's a good idea to open a business. You can go for it. Okay, so now on a financial point of view, the best alternative seems to be the coffee shop. Okay, because it's the one, according to our assumption, which leads to the highest NPV. So if your goal as a person is to make the most money you can, you go for the coffee shop. Okay, so that would be the first thing I would say. Maybe we could say also, if you are more romantic or not 100% a money person, you could say all the possibilities are NPV positive. Okay. So if you prefer music because you love music since you are a child, go for it. But it's not the optimum project on a financial point of view. Okay. But it's still a positive NPV. But if you want to go for the best alternative in terms of, in a financial point of view, you go for the coffee shop. And then maybe what the other thing we could say is that, okay, this one has a highest NPV, but as we said, it's maybe normal that the bookstore has a lower NPV because the investment is also 25% less than the other ones. So of course, maybe the amount in dollars is lower. Okay, so maybe it's a good thing also to calculate the IRR in this context, right? So it's not calculated actually. Yes, it's calculated afterwards. Okay, so you have it here. Okay, so this is here. It's calculated. So you can see that. Okay, when we calculate the NPV, so bookstore is lower than the coffee shop, but when it comes to the IRR, it's higher. Okay. So the real question here, in my opinion, is on a financial point of view, what do you do with the 100 you don't invest? Is it something that you save somewhere on a bank account and then it's going to earn something? This is what you have to decide. That's the first thing. The second thing is, on an accounting point of view, maybe more than a financial point of view, now I would say to this person, how easy is it for you to borrow money? How easy is it for you to find the $400,000? Is it money you have already? Or is it like you have money, but you have to borrow money? And so on. And what is the cost of the financing and so on? Okay, so that would be also the thing we have to think about. So when you have projects with different sizes, it's not so easy. We have to be careful. Okay, so what says the sometimes they say, okay, if a project size is doubled, the NPV will double. This is not the case for the IRR. Okay. So the NPV cannot be used to compare project with different scales. Okay, so we have to be careful again here to compare these two because we do not have the same size here. Okay, so it's really, so NPV, IRR give you a clue, okay? But since the projects are not totally identical, you have to think about other criteria. Okay, so again, what is the money you have already? How much do you need to borrow? How hard it is for you to borrow that money? What is the cost of financing for this money? Okay, are you more interested as a person in selling coffee or selling books? And so on, okay? So this is also interesting to see that if we want to compare projects of different size, our tools are not perfect, okay? They are only tools to help, but they are not perfect. Okay, so a last indicator that we can discuss when you have it's when you have resource constraints. Okay, so in that case you can calculate what we call the profitability index. Okay, which is NPV divided by investment globally. NPV divided by investment. You have several definitions of this. Sometimes you get PV divided by investment, so you can find online, but I think here we use NPV divided by resource consumed, okay? And so this profitability index will be helpful for you to identify the best combination of projects to undertake. So let's illustrate with an example. Same thing here. Can you check with me that you have the solution afterwards or not? Maybe not this time, but can you tell me if you have the solution? Do you have all this? The red line and everything? Can somebody tell me in the chat if you have this slide which is showing? Okay. So okay, so I will share that today. So profitability index. So here you have 4 projects, okay? So I'll let you 5 minutes to do it then. You have only $300,000 to invest, okay? Which project do you select? Okay, so you got the project A gives NPV 230 with an investment of 200. And the profitability index is 1.15. So it's 230 divided by 200, okay? For B, we get an NPV of 100, 250, and we get an investment 125. C, 194, 175. D, 162, 158. So you get a profitability index here. And so you get 300,000 to invest. So just not doing the calculation, what is the only project of the combination of 2 projects that you would take here? So please share me in the chat the letter. So do you go for A plus B, B plus C, C plus D? So we have Hien who says B plus C, okay. Is there someone else who has another solution, another proposition? A and B, okay. So you cannot do N and B because A and B you go higher than 300, 200, 125. So you cannot do A and B because you have this constraint of 300,000. Okay, so you cannot go for A and B. B and C you can, 125, 175, it's 300. But as you can see, it's not the ones with the highest profitability index, right? So is there something else that can be optimum, like taking A alone, or I don't know, something else, B plus D, for example, B plus D instead of B plus C? Of course not. Of course not. The optimum is, as Hien was saying, it's B plus C. So how can we, let's say, discuss that better? Well, we can calculate what we call the weighted average profitability index. Okay, so in the case of okay, I'm going to try to do something here. I'm going to try to go on Excel, but copying past. my data so we can see. Okay, not so good, but still, I think it's not so bad. So it's not very pretty, huh? But you have the data at least. Okay, so for the WAPI for B and C, how do they calculate that? Well, it's done like it's 125 divided by 300 multiplied by 113, okay, plus 175 divided by 300 times 1.11, okay, and so that's how it's calculated. Okay, so maybe I'm gonna do this. I'm gonna share that in the chat. That's better. And so I can come back to the PDF because the PDF is more clear than the Excel. Sorry for that. Okay, so I'm back on the, okay, so B and C, okay, B and C, this is it. So how do they calculate 1.12? So so you take 125 divided by 300, okay, because 300 is your total, the total investment you can do, times 1.13, okay, and plus 175 divided by 300 times 111. So this is 1.12. Okay. If we do for B and D, just to be clear, so B and D, so we get 125. Okay, 125 divided by 300 because 300 is our total that we can invest. Okay. Okay, and so that's B and D, right? B and D. So time the profitability index of B, okay, 1.13 plus, so D, it's so 150, okay, plus 150 divided by 3 multiplied by 108, okay. And so as you can see, we got in the calculate. So you should find, you can check for me, but you should find 1.01. And what you can see is that what I shared in the chat, in the formula, is that you get 125 divided by 300, 150 divided by 300. So there is finally 25 divided by 300, for which actually we have 0 profitability index, okay? So this is how you calculate the WAPI. The WAPI will be lower here for B and D because there is 25,000 out of 300 that we did not invest in a project, okay? So that's why, for example, A alone is not efficient, even if A has the highest profitability index, because in terms of formula, this is what we will have. So give me 1 second. So 0.077, okay. So this is what you have for A, for the WAPI of A. So you have 200 divided by 300, okay, 200 divided by 300 investment multiplied by 1.15, okay. But you also have, sorry, it's not correct what I wrote, so I'm going to correct. But you have, this is correct. So 200 divided by 300 times 1.15 plus 100, okay, the rest of the budget divided by 300 times 0, because there is actually, it's not optimal to take only A, because there is 1/3 of your budget you do not use to invest in a project, okay? So you're losing the opportunity to invest 100. So for this 100 $100,000 that you do not invest in a project, the profitability index will be 0, the NPV will be equal to 0. So what I mean is that here, it's not the one with the highest profitability index individually that we must take into account. We must take into account the best combination, okay? And the best combination happened like Ian was suggesting when we have actually, when we take the two projects that help us, to reach, to take advantage of the $300,000 that we have as a total budget. Okay, so that's the optimum that you have. Okay, so the takeaway of this example is that when you have a budget constraint, okay, so you have to take into account this constraint to calculate, you know, the best combination which is possible for you. Okay, so that was it for this one. Do you have any question in the chat or any remark or? Okay, so we can move on. Okay, so now we are entering the capital budgeting chapter. So this is when we're going to calculate the NPV for a project, getting into more details. And this part is really the part that's gonna link to your group work. Okay, so what we do now is something you will have to do for your group work as well. Okay, so this is now that we discuss the different topics related to the group work. Firstly, let me introduce the topic. So the topic is capital budgeting. Okay, capital budgeting is actually analysis of investment to see which one we must accept. Okay. Okay, so basically what we want to do is to calculate the NPV or the IRR of one project to be able to decide. Okay. To do so, you have actually an example in your in the PDF document, which is called capital investment rules, investment decision rules, and capital budgeting exercises. So you have the PDF document. So I invite you to open this document, okay? Because we're gonna read. This is the case we're gonna follow here. So we're gonna read that together. And you also have a Excel template, which is called HomeNet. So we get, so please open investment decision and capital budgeting exercise and budgeting exercise, and please open the HomeNet Excel template that you must find. So sorry, the previous line was not very clear. So investment decision, capital budgeting exercises, and HomeNet template. Okay. So please have these two documents ready. So let me open it as well. It's normally it should be open somewhere. Yes. Okay. So I stop sharing my PDF and I just go into the Excel file. Okay, so this is the HomeNet case that you must have somewhere. So this is the document you have, okay? We're gonna discuss it. So this is what we're gonna do together. We're gonna fill in these different charts, right? And so at the end of the day, we're gonna calculate the NPV of the project, okay? And maybe we're gonna calculate the IRR of the project as well. So we can see that we have several steps to follow, right? And so for each step, I invite you to fill in the Excel file, okay? And this is also what you will have to do for your group work as well, okay? you will also have to finally create the assumption for your case here, and then calculate the different parts to calculate the cash flow of the project and the NPV. Okay, so this is what we're going to do together now. In that part of the course, we're gonna discuss how we can calculate the net income of the project every year. So we're gonna think about income statement, but not the income statement of a company, but the income statement of the project. And also later on, we can see that in this document, we calculate the free cash flow of the project, so the cash flows of the project. So it means that here we are thinking about calculating we use the cash flow statement, but not for your company, but for your project. So that's why I wanted you to know what an income statement and what a cash flow statement are, because we're going to use the structure of those documents to be able to calculate our project here. Okay. Okay. So globally, what we can also say is that what we have to do, okay, we have to calculate the free cash flows of our project for every year. Okay, every year. Okay, and the free cash flow of the project will be like this. It's gonna be net income of the project and then so that will be made with income statement approach. Okay, so it means that we're gonna calculate, so what are the revenues and expenses associated to our project. Okay, associated to our project. Okay, and then we're gonna have a cash flow statement approach. So in the cash flow statement approach, we got net income, then we got plus depreciation, okay, minus increase in the working capital, increase in the working capital, and that will be equal to our operating cash flow. Okay. Then minus investment, which is also called the CapEx, which is for capital expenditure. Okay. That will give our free cash flow. Sorry, I forgot to. Okay, so here I'm just saying that what we're going to do in the next 2 hours. This is what we're going to do in the next 2 hours. Okay, so if you're a little bit uncomfortable still with these different names, do not be so much worried, because we're going to detail that now. Just keep in mind that this is our strategy. Okay, what we want to calculate the free cash flows of our project, okay? We want to calculate the free cash flows of our project, okay? So to calculate the free cash flows, we're gonna think about what we know about the financial statements. So we're gonna calculate the net income of the project for every year, and then we're gonna calculate the free cash flow of the project, okay? And to calculate the free cash flow of the project, we're going to use an approach which is made with the cash flow statement approach. So this thing that you have on the screen here represents a simplified cash flow statement, okay? If you look at a cash flow statement, so maybe I can have a look in the document I shared with you for the cash flow statement. Let me find it. So sorry, I take a little bit of time because I have to find my file. MEBF, pre-reading. What are the financial statements? Okay, so tac, tac, tac. You should see it. Voilà, statement of cash flows. So you have it here. See, so net income, okay, plus depreciation, minus or plus or minus cash effect of changes on accounts receivable, accounts payable, and inventory. So this is a working capital, okay? So this is a cash flow from operating activity. And then investment activity, so cash from investment activities. And so this is our free cash flow, okay? So we are using the logic of this document that people use in accounting to be able to build a cash flow statement with historical data, except that we're going to use this document to calculate the cash flows of the project, only of the project, okay? So this is what we're going to do. I would need to know if you have any questions or if it's clear or not so clear for the moment. Because of course, this time, this is when we know that you didn't have the financial analysis class before when you usually study the financial documents, okay? So now, this is now that we see if you are comfortable with this document because you did the pre-reading or because you studied that in the previous time of your life at the university. So do you are you comfortable with the vocabulary, income statement, cash flow statement, working capital, or something like this, or do you have any question? Okay, so I know you guys, when you're silent like this, it's not okay. Knowledge but not calculation. Okay, yes, Prof, we learned this before. Okay, okay, good. So I'm thinking again about the engineers in the room or something like this. Okay, I know for you it's a little bit more tricky because you don't have still the vocabulary, but again, do the readings and we're gonna do the case together now, hand in hand with the Excel template. So I think it's quite interesting. Yes, I'm excited also to show you because it's very interesting. So I should share with you now. Okay. So I go into the document called Investment Decision Rules and Capital Budgeting Exercise, because this first page you can see, yes, the first page is HomeNet data. So this is the data for the case we're gonna do together in the next minutes. Okay. So usually when I'm in the room with you, in Vietnam, I said to you guys, open your computer with Excel with the template and take the paper with the HomeNet data on the side so you can keep track of the whole picture of the case. Okay, so we're gonna go step by step, but do not forget the whole picture of the case. So let's have a look. Let's read it. Let's read it already. Okay, so we consider a hypothetical capital budgeting decision faced by the managers of the Linksys division of Cisco. Okay, so the project is called HomeNet. So usually all these projects are usually innovative projects. Even if the book this example exists for a few years already, so maybe it's not so innovative anymore, the case, but usually it's innovative projects. Why? Because innovative projects are the most risky, right? So these are the ones for which you need more to to make some preparation and calculation to be sure that the NPV is positive before undertaking the project. Okay, so let's have a look at the different assumption, and then we do the different steps together. Okay, so the company has already conducted a feasibility study, which has a cost of $300,000. Okay, so you paid already $300,000 in the past to be able to analyze if the project is feasible or not. The project has an estimated life of 4 years. Okay, 4-year life, 4 years life for the project. Okay, so it means that certainly we will have cash flows. Maybe I can go back to the Excel file for HomeNet. Where is it? Here. And okay, and so we go there. And so, okay, so you must see my Excel now. So we can see we get actually 5 years here. Okay, so certainly the year 1, 2, 3, 4 that you can see, hopefully, I hope you can see them. Can you see my Excel? I'm not sure you can see it. No, yeah. Okay, so I share it again. Normally you should see. Okay, now you should see. Okay, so you can see for the project you have year 0, 1, 2, 3, 4, 5. Okay, so the project it is said that your project have 4-year life. Okay, so so you must have revenues and expenses during these 4 years. Okay, and so we're gonna discuss what is happening year 0 and 5. So because usually in one project you have the 4 years in yellow, which are the years of, let's say, activity of the project. You have the year 0, which is usually the pre-production cost. And okay, so you cannot see the Excel file. Okay, so this is what so normally you should see the Excel file now. Can you see the Excel file now? Okay, so yes, so you got here, you're gonna have the 4 years of activity of the project. Okay, and so you got usually 2 other moments in the project, the year 0 and the year 5. Okay, so sometimes you don't have a year 5, but you usually have year 0, because if you remember when we did the calculations before, this is usually year 0. This is the moment you invest. Okay, so you cash out to buy the machine. Okay, so year 0 you buy the machine, and then year 1, 2, 3, 4 you produce and sell. Okay, so you get a negative cash flow here, and you get a positive cash flow 1, 2, 3, 4 normally. And then year 5, sometimes you have special items that we will discuss together that happen. Okay, like things that can happen when you finish something, right? You can sell the machine, you can, I don't know, there is some other assumptions that we will discuss. It depends on the project. Coming back to my PDF document, by the way, just for you to know, I don't know if you're interested with this, but sharing experience of life. I'm in front of my window, and it is snowing here. So we get a snow, and the snow seems to stay on the roof. So it's going to be one of the first snow of the year. So I'm just sharing that with you because I know that we don't have the same climate these days. So it's fun to share that. Okay, so let's come back to HomeNet data. So we get the HomeNet project. So it has 4-year life. So that's why we're going to 0, 1, 2, 3, 4. Okay, so we get pre-production cost. Okay, so you will have to deal with that. Yeah, Santa Claus is coming to town, definitely. So we get pre-production costs. So you can see that in the HomeNet project, we will have to pay 5 million for engineer and design costs. Okay, software development will require 50 software engineers at $200 per year each. So here, maybe you can note somewhere two things. This pre-production cost, we will consider that as expenses. Okay, so consider that expenses in year 0. Okay, so please mark that somewhere. These pre-production costs are expenses year 0, 5 million, but also, you get 10 more million here. Okay, and it's only for 1 year. Okay, this software development will require 50 software engineers at $200,000 per year each, only the year 0. Okay, because per year it sounds like it's going to be every year, but no, it's just that they earn the yearly salary is 200,000. Okay, that's for production cost. So if you've got cost, it must be expenses. Investment. Okay, so investment, this is the machine you buy. Okay, machine you buy. Okay, lab facilities are already available, but you will require 7.5 million of new equipment. Okay, the lab equipment will be depreciated over 5 years period. Okay, so this 7.5 equipment will be depreciated over 5 years. Okay, so you will have to calculate a linear depreciation over 5 years. And I remind you that the project is 4-year life. Okay, so that is certainly why we have a year number 5 in the Excel. Okay, the software and hardware design will be completed and the lab will be operational at the end of the year. Okay, so at that time, HomeNet will be ready to ship. It's usually here, it's just a sentence for you to understand that year 0 we invest and only year 1 we produce and sell. So you get information from the marketing department. We expect to have 100,000 units sold per year. It will retail for 375 with an expected wholesale price of 260. So I think this is the one we should take into account, 260. Production cost, actual cost production will be $110 per unit. Okay, so this one, production cost, which is also cost of sales, will be a variable cost because it's a cost per unit. Okay, and the company will spend 2.8 million per year on marketing and support. So it sounds like you have a fixed cost for marketing as well. Okay, so we forget the externalities for the moment. We see that later. Okay, so these are the assumptions we need to keep in mind. Okay, so coming back to what we have here. So our project, we just completed a 400,000 feasibility study. We have 4 years life, the sales, the price, the selling price, and so on. Okay, now what is the information we should take into account in our project? So this one is very important for you. This slide is very important for you. What you have to consider when you do the NPV calculation for a project like this, you have to think about I'm going to write down in the chat everything that is changing with the decision you are taking. Okay. This is what we call incremental. Okay, so if you invest in this machine, what are the consequences for you, positive and negative? What are all the things that are changing with the decision? Okay, so you have to consider all the information which is incremental. Okay, the amount by which the firm's earnings are expected to change as a result of the investment decision. Okay, so that's very important for you to keep that in mind, okay, for your life in the future when you do some things like this, for your group work, but also for HomeNet. we take into account everything which is incremental. So everything that is changing because you take the decision of this project. So you're gonna have direct changes, okay, such as sales, for example, new sales, for example, okay, and you will have indirect changes. We will talk about this is what we call externalities. Okay, so I have a question for you already. We have just said just before that our company did a feasibility study of $300,000 to check if it was a good idea to undertake this project. So my first question for you, and I expect an answer in the chat for that question. So do you think the $300,000 feasibility study is an incremental cost of the project? Should we consider $300,000 feasibility study in our project? Yes, no, and why? No for Dong. Okay, maybe why? So that's correct. That's no. That's a no. Okay, I agree with that. Why is it that we should not consider? Do you have a vocabulary term for this, or? Well, actually, we have it just here. It's because it's what we call it's a sunk cost. That's correct, Tree. Because it's not affect the decision to accept reject. Because no matter you take the project or not, you lost the money. It's a sunk cost. Exactly. You guys understood exactly what your explanations are very good. Yes, it is a sunk cost, and the definition of the sunk cost is that you lost the money already. You undertake. It's not a cost that's gonna appear because you take the decision to undertake the project. It's already money you spent. Okay, it's a cost from the past. It's finished. Okay, so if you take the decision to undertake the project or not, it's not going to generate this cost. It's already done. Okay, so it means that it is not an incremental information. Okay, so among the incremental information, we should not take the sunk cost. Yes, so yes, I agree, Dong. Hien, thank you, Dong Hien, Chui, and the other people. It's a sunk cost, so we should not take that into account. So okay, we are on the same page. Okay, so that's the summary of the case. So now, okay, now it's the exciting part is beginning. We're gonna work on this case. So I'm gonna let you work on this case, and we're gonna go step by step. Okay, so you should see my Excel now. Okay. And I'm sorry, I'm going to stop share this one because I want to come back to my global strategy, which is here. Okay, so sorry, give me 1 second. It's not so easy to switch from one to the other. Okay, so you should see the Excel file about the strategy. Okay, we want to calculate the free cash flows of our project. So we're going to work on this first step. Firstly, calculate the net income of the project. That's our first step. Okay, so we're going to focus on this first step. Let's say we're going to even call it by the name of the table that we have in table 8.1, table 8.2. Okay, so for the moment, we're going to focus on these ones. Okay, table 1, table 2. So we're going to be here. Okay, so for the moment, we focus on this one. Okay, so let's come back to the HomeNet case. So we got so we're going to firstly focus on the table 8.1. Okay, in this table we do not consider externalities. Okay, we're going to do it in two steps. So as you can see, you got the key assumptions here. So same for your group work. I think it's going to be very important for you, even when you want to show to me and to your colleagues in the PowerPoint document what has been when you want to present your project. I think it's going to be interesting to focus on the key assumptions, because you will say, oh, in our group work, we consider that we will be able to sell 100,000 units the first year, but then it's going to be 120 the second year, and so on and so on. Okay. And so you're going to explain why you have such a selling price per unit and so on. And so here are all the key assumptions. If you build your Excel file in a, let's say, efficient way, you put all the data here, okay? All the assumptions. And so when you have something here in the tables, it's only formula. It's only formula that you use here. Only formula, no data. So when you change something here, it's going to change automatically here. So you're going to be able, to check, what if we, and so if we consider a little bit more for the selling price and so on and so on. So it's going to be very interesting for you, to give you the opportunity to have only formula in this part of the document. So for example, here for the sales, I'm going to take the quantity I'm supposed to sell times the selling price per unit. Okay, so it sounds like the incremental level of sales for this project should be 26,000 the first year, and so on. Okay? So your goal now is to calculate the net income, okay, for the year 0, 1, 2, 3, 4, 5. For this project, do not consider externalities. We will see that in a second step. Okay, so I'll let you 10 minutes to do it. Okay, and we share the solution together afterwards. Okay, so good luck. You have any question, please use the chat. I don't know where you are, if you're finished or not. I was thinking maybe 5 more minutes. Can you say in the chat what you think about that? Yes, 5 more minutes. Okay. Okay. So let's, you know what? It's 8.08. So 8:15, I correct. Okay. 7 more minutes. Okay, so it's 8:15. Is that okay for you guys now? If we make the solution together? Or do you need more time? Okay. I think maybe it's time to, yes, okay, that's okay. Because when I, again, when I'm in the room with you in Vietnam, I can go and see, I go and check on everyone's computer. And so I can see when it's finished. So this is why I need your feedback here. So thank you for your feedback. I know that it's not easy to say, yeah, I'm finished. Maybe some other didn't, but we have to find a pace. So we finish what we have to do today. Okay, so sales. So the sales, as I said, the quantity times the selling price. Okay, so no big deal. And so we can drag the formula here. For the cost of goods sold, we can take the quantity time the cost of goods sold per unit. Okay. Personally, I put a minus sign before. Okay. Here. So it can. Oh, sorry. Okay. Forgot to share. I forgot to share. Okay. So let me go back from the beginning. So for the selling, sorry, thank you. Sorry for that. So the quantity we sell with the selling price. Okay, so we get 26 and I drag my formula over 4 years because here, of course, it's going to be this one times this one. So, even if I change an assumption here, we're going to change it here as well. So it's okay. So we got 26 million, right? For the incremental sales of the project. So for the cost of goods sold, as I was saying, I'm going to put a minus sign here. So when I do cost per unit time the quantity, I got already a minus information in my income statement. So I understand it's an expense. It's not compulsory to do so. I know some students, they prefer to have the absolute value, okay, because they know that, they're going to do this minus this to calculate gross profit. Frankly, I don't care at all. I don't care at all. It's just, I prefer to do this way. Why? Because I think that my Excel file, maybe I will share with people who are not specialists in finance, like my manager, for example. So maybe it's easier for the people who are not in finance to understand, if you put a minus sign for the expenses, maybe it's more intuitive for them. But frankly, I don't care. Okay, the important is that the process is correct. So for the gross, so we got 26 million for the sales, 11 million for the cost of goods sold. And as the cost of goods sold is calculated as, $110 per unit times the number of units, again, we consider that it's a variable cost. Okay, because it's a cost per unit time a quantity. So these things we will rediscuss next week with the financial control. But since this is the approach here, it's, I prefer to say it as well. So since I have a minus sign already, I just have to sum the two to calculate the gross profit. Okay, so my gross profit is 15 million. Okay, then we get an information about the selling, general and administrative expenses. So this one, it's said to be 2.8 million flat. Okay, so this is what you have. And sorry, I forgot to say, so maybe you use that already. I forgot to say that for the moment, we don't consider the lost rent and we don't consider the existing router because that's externalities. We're gonna talk about that later. Okay, so 2.8 million. And so research and development. So research and development is about these guys here. Where is it? These ones. Yeah. So that's the 5 million plus the 50 engineers times 200 per year. Okay. So 50 times 200, this is 10 million plus 5 million, so it's 15 million. And so this amount is year 0 only. That's pre-production cost. Okay, so pre-production year 0 only. Year 0 only. Okay, depreciation now. So depreciation is over 5 years. Linear over 5 years. So it's going to be the investment, 7.5 million, multiplied by 20% depreciation rate. Okay, and so I'm going to put some dollars here to fix the 7.5 million so I can drag my formula. Okay, and do not forget it's over 5 years, so we have an information for year 5 here. We don't sell, we don't have production costs, we don't have administrative costs year 5, but still we have the 1.5 depreciation. It's like the machine is still there, so it's going to lose value. Okay, even if we don't use it for production. Later, we will consider that we sell the machine at the end of year 4, so we will not have the depreciation year 5. For the moment, we have it, and so it's a little bit of a theoretical assumption. Okay, so now we can calculate the EBIT, earning before interest and taxes. Okay, so I drag. And so now we have the income tax at 40%, so EBIT times 40%. Okay, and I'm going to put a minus sign in front of it. And so we get the unlevered net income then. So that's the sum of the two. And I can drag. So that is correct. By the way, you have the answer in your PDF. I usually let the answer to these tables in your PDF document. So in the theory, okay, so you can check, okay, because I don't want to lose time. So this is correct. So usually at that point, there are 2 questions or 2 remarks from the students. So what are the 2 things which are surprising? Is this DTA? What is DTA? Sorry. I don't know the name DTA. Deferred tax. Ah, okay. No, it's not deferred tax. It's not a. It's a. Okay. So the first point, which is surprising, is the fact that we have a positive tax in year 0 and year 5. This is when we have a negative EBIT. Okay, so usually you students, so it's correct. Okay, so I let it this way, it's correct. Now we have to understand why we have this situation. And so 3 is saying, try to understand and say, okay, from what I know, from my personal knowledge, maybe it's about deferred tax problem. Okay, so if I interpret what you say, it means that if we have a negative EBIT in year 0, we should be able to, pay less taxes in the future, because we will be able to, decrease the profit of next year from the loss of this year, and so on and so on. So yes, that's correct at the company level, but this is not what is happening here. So is there someone who would like another explanation why we have a positive tax in green here? Meaning it's like
the government giving us back some money, right? We have a tax shield or something like this. Why is it so here? What is my question is the income statement we have here at the company level or at the project level? It's at the project level. Okay, so knowing this, why we have 6,000 positive then? This is the income statement only of one project. What can happen? Okay, I'm gonna help you. So we have, so maybe other projects. Yes, Ian, this is it. So we consider that this income statement is, okay, negative year zero for this project, but maybe other project will be profitable. So the fact that we have a negative EBIT for this project, it's gonna decrease the positive EBIT of other project and ultimately decrease the EBIT of the firm. Okay, so our project is only one project among others. So the fact that we take the decision to undertake this project will decrease the EBIT of the company by 50 million this year. And so the company will decrease the taxes in year zero thanks to our project by 6 million. Okay, so the only thing that we still have to assume, and this is usually what we assume that the company is globally profitable. Okay, so it's not deferred, it's our project with other projects. Okay, and so my last question, and when you find the answer, we have the break, so we have an incentive to to find the answer to that question. What is the expense that usually you find in an income statement that you don't have here? What is the expense that usually you find in an income statement, but you don't have it here? Which one is it? Yes. Bravo, interest expense. We do not have interest expense. We do not have any financial interest or financial income. Okay, why? Because we consider, when we want to know if this project is a good opportunity for us, we consider only the investing decision. We do not consider the way the project is financed. Okay, we do not consider, we never do. So it's very important for you to understand that and to remember this. When you do an investment project like this, never financial income. So this is why you can see here in green now, it's called unlevered net income. It means it's a net income without the impact of leverage, without the impact of debt. And maybe, I don't know if you know this word, NOPAT. I don't know if you know that, but this is the same. It's net operating profit after taxes. Okay, so that's the same. It's a synonym. Okay, unlevered net income, you could say it's the NOPAT as well. Net operating profit after taxes. So we go in the income statement, we stop at the operating profit level. Okay, and then we take into account some taxes to find the unlevered net income, so the net operating profit after taxes. Okay, so never consider the impact of interest in a project like this, because it's a different decision. The financing decision is a different decision. In your Berg de Marzo book, it's another chapter. I don't remember which one it is, but it's a different chapter. Okay, because we want our machine to be profitable without taking into account the impact of how it's financed. Okay, the way I say it sometimes is that when you have a machine somewhere in your company, it doesn't have a label on it how it's been financed. It's not going to be more or less efficient, It's not going to produce more or less product because you finance with debt or with a leasing or with auto financing of the company. It's not going to change the machine. It's going to be the same machine. Okay, so we don't care how it's financed. So please never consider interest expenses in the income statement of a project like this. Okay, so it's not the net income we calculate, but the unlevered net income, or the NOPAT, the net operating profit after taxes. Is that okay for everyone? Any question? Okay, so we can stop for 20 minutes now. Okay, so enjoy your dinner, enjoy your tea, enjoy your break. And so it's 8:30, so we go back at 8:50 for the next step. Okay, so see you later. Have a nice break. Okay, everyone. So it's 8:50. So we are going back for the second part of the class. um, so I'm gonna go back to the PDF theory for a few slides. So we finished table 8.1, right? So we calculated again the unlevered net income of the project, but we did a first version of it. We did it without taking into account externalities. Okay, so what are the externalities? What are the indirect effects that you can have on incremental earning? So we took into account the direct effect for the moment. Okay, direct effects, sales, costs, and so on. Now we need to take into account indirect effects because again, uh, what is important is that we take into account everything that is changing uh, with the decision we are taking. Okay, so I'm just copying past a message that I put in the chat before. Okay, so everything this is changing with the decision you are taking is incremental. So we did the direct changes, okay, new sales and so on, okay, and now the indirect changes, the externalities. So we have two types of externalities that we can discuss. The first is what we call opportunity cost. Okay, so it's the opportunity cost is the cost of being deprived of something. Okay, the fact that we take the decision will take something away from us. Okay, because we took the decision. Okay, typically if you decide to be a student for 1 year instead of working, the opportunity cost is the salary you will not earn because you decide to be a student. Okay, of course it's an investment for the long term, so maybe you're gonna have positive effects, but you're also losing the salary you will not receive, so it's an opportunity cost for you. Okay, so we have to take into account opportunity cost since they are incremental. They appear because we take the decision to do the project. Okay, so in the HomeNet example, they say that space will be required for the investment, so we will not be able to rent the space that we could have rented if we do not do the project. Okay, project externalities. So opportunity costs. So this is it. Okay, Linksys could have rented out the place where HomeNet will be manufactured for $200,000 per year. Okay, so the opportunity cost is the lost rent. Okay, and so you add the lost rent in the selling and administrative expenses. Okay. Other externality would be the what we call cannibalization. So cannibalization is maybe usually the example I take. Well, it's worse what it's worse, but it's usually I say, okay, when you got the new iPhone that comes on the market, okay, some people that would have bought this old iPhone will not. Okay, so the fact that there is this new iPhone coming out, okay, you get new sales, but maybe you are losing sales on other products because of this. So you have to take that into account. Okay, so so you have to take that into account in two places. The first is for Omnet is the sales. Okay, so 25% of the sales come from customers who would have purchased an existing router if Omnet was available, and the selling price of this router was 100. So we lose sales of old product, okay, for with 100 selling price, okay, and 25% of the quantity of this old product. So that will be a decrease in the sales. Okay, so you have to put that in a decrease in the sales. And the other consequence of this is that you save the cost of goods sold on these 25% you do not sell anymore. Okay, so these are the two consequences of it, and this is $60. Okay, so I'm leaving PDF, coming back to Excel, and so now I'm gonna let you work on. So you should see my Excel with a lot of colors in table 811. So now we're gonna, so you're gonna do the same job, okay? So you're gonna recalculate the unlevered net income, but after externalities now. Okay, so just for you guys to know, in the group work, you do not need to show me two different income statements. You can directly show the second one that includes everything. It's just that for pedagogical reasons, we usually split that into two steps so you better understand. But of course, when for your project, table 8.2 will be enough if you want to present something. So the lost rent, it's here in purple, okay, and the existing router is here for the cannibalization, and you got all the information, 25%, so that means 25,000 quantity that you don't sell at 100, and the cost of it is 60, and for the lost rent, we lose $200,000. So normally, compared to what you have before, okay, these are the places where you should have things to change. Okay, so maybe this one I don't put no field because, okay, so you need to change data here. Okay, you need to change data here and here. So here the lost plus the lost rent, okay, minus lost sales, minus lost cost of goods sold. Okay, so okay, let's say that's going to be maybe more plus saved cost of goods sold. Okay, so I'll let you work on this. I'll let you, it's 8:58. Let's say that I'll let you 7 minutes to do it, 9:05. And I will ask you if it's enough or if you need more time. So please do table 8.2 and then we discuss the solution. Okay, so it's 905. I think it's enough for this part. You have the solution which is shared for the moment on the PDF. Is that okay, or do you need more time? Okay, so this is what I thought, because finally it goes faster, I think, for this one than the previous one. So you still have some time, maybe by following what I do. Okay, so I'm going to do it clean, meaning that I'm not going to take information from here, but from here. So this times this, okay, and so that's the old sales. I mean the sales, the sales of the first version, and now it's gonna be minus 25,000 times 100. Okay, so the net sales is now 23.5 million instead of 26 million. Okay, so what does it mean? It means that if we take the decision to do HomeNet, we were going to have new sales of 26, but we're going to lose sales for 2.5 million. So finally, the increase in net sales due to our decision, it's only 23.5. So this is what we have to consider, because we have to consider externalities. For your group work, you will have also to try to think about externalities to show that you understood how it works, right? So for the group, for the cost of goods sold, so we get 100 times 110, okay, plus 25 times 60, okay, and I think I'm gonna just add a parenthesis and some negative sign. So now it's 9.5. So it means that instead of 11,000, the fact, so we're gonna have new cost of goods sold for 11,000 with the new product, but we're gonna decrease the cost of goods sold of the existing product by 2.5. So the net cost of goods sold incremental of our project is 9.5. Okay, so now we have a new gross profit with this new assumption. Okay, 14 million instead of 50 million. Okay, so taking into account externalities decreases the gross profit for our project by 1 million. For the selling and administrative expenses, now we have the 2.8 million, but also the lost rents, meaning the opportunity cost. So the new selling and general administrative expenses is 3 million. Okay. For the research and development, it's still 15 million, so no change for this one. For the depreciation, same thing, it's 7.5 times 20%. Okay. And I'm gonna put some dollars here. Okay, so I can drag my formula for 5 years. And so I now can calculate the EBIT. This is it. Maybe I'm gonna bold it. Okay, and so 40% of income tax, okay, minus sign. So we still have our 6,000 tax shield in the year 0, still the 600 in year 5, because for these 2 years there are no changes. And so this is now the unlevered net income after externalities. Okay, 9 million, 5 million, 7. So we can see that it's the same here. Okay, maybe it's a little bit theoretical. Okay, because we consider that the sales are the same. And so year 5, again, we don't have anything except the impact of depreciation. Okay, so that's it. Any question about this second step? When indirect effects of the project increase the sales or other existing business activities, how to take into account the effects? can we use incremental gross profit or incremental net profit of other businesses when calculating the incremental earning forecast of new project? Theoretically, yes. If you go for a supermarket, for example, if you open a new, how do you know, a new part of the supermarket that sells, I don't know, sushis. Okay, you have sushi and you didn't have sushi for the moment. Maybe new people will come to enjoy for the sushi. Okay, so maybe you will lose sales from other restaurants, but maybe you will increase the sales of, I don't know, selling bread, selling bubble teas or stuff like that, which are not in competition with the sushis. So theoretically, yes, you could have positive indirect effects. Let's say positive cannibalization effect, if you prefer. Yes, especially in that kind of situation. Of course, you have to be careful because it means that you increase the profit of your project. Okay, so maybe you will give the additional chance to for the project to have a positive NPV. So you have to be careful that you not forget additional costs. But theoretically, yes, it could happen, especially in this case of a supermarket or a mall or something like this. You know, in France, when I was in France, we usually said that supermarkets, big supermarkets, they were selling bread, because we French, we like bread, right? We like the baguette, la baguette. So the supermarkets, they were selling baguette, and usually the people were saying they are selling baguette at a very low price. And usually they don't make even profit on the baguette. They sell at, without margin. Why do they do that? Because behind that, it's exactly what you suggest, that people will come to the supermarket instead of going to the bakery to buy their bread. And so they will buy fish, potatoes, vegetables, shoes for the kids, jackets for the kids, and so on and so on. So yes, so it's like you can attract customers with the la baguette. Maybe you don't earn a lot of money with that, but you get, as we say, let's say positive cannibalization or positive side effects of it. Does it answer to your question? Yes, but again, be careful, especially when a project, don't take too much of it, because people can think that your project is not profitable without this effect. And so that you're trying to make it more beautiful so people accept to undertake the project. So if you do that, for example, for your group work, that could be an original assumption. So this is typically what can be interesting for you guys to show, to have original ideas about adapting what we did together to a context of a project. So it can be interesting. If I were advising you, if you do that for the group work, for example, I would suggest that you have a positive NPV without this indirect effect. Okay, if not, maybe as a manager, I would say it's maybe dangerous. Okay, so we are done with this next step. So I come back to my PDF version. So we are here. Okay. So to conclude with this table 8.1, table 8.2, so do not forget that in the real world, typically it's more complex. So sales will change from one year to the other. So that could be also an assumption for you, for your group work. We can consider, for example, that if you launch a new product, it's going to be like this. You got sales and top sales, and then maybe the last year that you have less sales. You can also take an assumption about the average selling price will vary over time. Same thing, we can have, a discount on the selling price the last year or the 2 last years. And the average cost per unit will change over time. So this is the assumption you can take. You can take assumptions that the selling price will grow by 2% from one year to the other because of inflation. And then you can consider that the average cost per unit will grow by 2% because of inflation as well. All the assumption you can take, okay, but you have to justify. So when you do your group work, you really have to, justify all the assumptions you're taking. So it's not about the NPV calculation. It's not that which is the most important. It's about if you are coherent, okay? If you show coherence in your choices, if you show that you've been carefully thinking about what are the consequences of each decision, okay? So it's it's a storytelling. You have to show that you understood all the process, and you show with your context of the project that you know you understood what we did together. Okay, and if there is a one calculation which we disagree, no big deal, as long as we have something which is coherent on the whole. Okay, so we finished with table 8.1 and table 8.2. So let me, switch to another Excel file, which is the Blackboard thing. So we did that, right? We did this once. Okay, we finished table 8.1. So we calculated now I can correct this, unlevered net income of the project. Okay, so we did that. So now we're going to move to the next step when we do all this. Okay, so we go from we finish with the income statement approach. Now we're going to switch to our cash flow statement approach to calculate the cash flows of the project. Okay, so what we do, what we will have to do now is to ultimately, so you should see home net now with all the colors. Ultimately, what we want to do is this table 8.3. Okay, so it's the unlevered net income. So this will be the one we calculated already. Maybe we don't have to write it again. So we are here, right? We finished this. So that's table 8.1 and table 8.2. So now we're going to focus on this. We're going to focus on this. Okay, so again, so that's unlevered net income plus depreciation, less capital expenditure, less increase in working capital. So plus depreciation, it's no big deal. Capital expenditure, it's no big deal also. That's the 7.5 in the 7.5 we have in year 0 here. Okay, maybe I'm going to change the color so it's not changing a lot. Brown, maybe, yeah, brown, it's easier to see. So brown is about our work now. So brown is here too. So for the capital expenditure, it's a 7.5. Okay. For the depreciation, well, maybe we can pick up the information somewhere here. So no big deal. And so the only thing which is maybe tricky to calculate is the increase in the net working capital. Okay, so this is what we're gonna focus on for the moment by focusing on this table, which is 8.4, but finally we're gonna do it before. Okay, so this one we're gonna do. So cash requirements, we don't care. Okay, there is 0 cash requirements. So we're just gonna consider that the working capital linked to the project, okay, so that's the working capital of the project, will be equal to inventories. So inventories plus receivables, okay? Plus receivables minus payables. So this is the definition of the working capital, okay? And maybe you can add one line here, which is the increase in working capital. That will be working capital year N minus working capital year N minus 1, okay? So you can put it here. So what are the assumptions here? I think there is no additional inventory, I think. But if you can put it in your group work, that could be interesting. So the idea would be to say, okay, now that I have this OMNET project, that I will have to have additional inventory because of the products I sell, okay? And so I will take an assumption for this. And for the receivables, in the case, they say that the receivables will be 15% of the sales and payables will be 15% of the cost of goods sold, okay? So what does it mean? It means because we implement HomeNet, it's gonna increase the receivable of the company by 15% of the sales of the project. So just in case you ask yourself, it's 15% of the sales net of cannibalization. Okay. And same thing for the cost of goods sold, net of cannibalization. Okay, so I don't know if you are familiar with working capital. That is my question. So you can share in the chat if you have any question about it or if you have any doubt. I did a funny video with ESCP a few years ago to explain what is a working capital. We earned a budget from a KPMG, and so they gave us some money to make some funny pedagogical videos to explain financial concepts. And so we did one with the working capital. So I will share it in the syllabus part of your canvas, so you can have a look at it. It's 5 minutes long, so it's funny. So it's maybe more for people who don't know exactly what it is, you know, like the people with engineering background or whatever. You can have a look so you better understand what it is in 5 minutes. At least you have a pretty much a better idea. For those of you guys who did some finance and accounting already and work in accounting and finance, I guess you know what the working capital is. So here, globally, here maybe I'm gonna, okay, no fill here, okay. So yeah, I'll let you finish table 8.4, okay, table 8.4. And also this, once you finish, calculate the free cash flow of the project, okay. So I'll let you, let's say 10 minutes or 15 minutes, 10 minutes maybe to do it. Except if you have a question for me now that you don't understand what you have to do. So firstly, you have to do is to calculate the working capital, okay, which is linked to the project, okay, which is made only on of receivables and payables. So receivables minus payables, okay. So that's the working capital of the year. Then my suggestion is that you calculate the increase in working capital, 1, 2, 3, 4, because here, this is the increase in working capital that you will gonna take into account, okay. So I don't see any question in the chat. So if you have, you can. If not, let's say 10 minutes, and we see if you finish the free cash flow. I shut the video for the 10 minutes, because I have nothing to say for the moment. I'm back. I'm back. Just to check with you if you had the time to do it or if you need more time. Okay, so I don't have anything in the chat asking for more time. So I'm gonna assume that we can go on because I think it's not too long to do. So I think you had enough time. So, okay, I don't see anything in the chat, so I go for it. I show you the solution. Okay, so as I said, the first thing you have to do is to calculate the working capital. So you take 23.5 for the sales time 15% for the sales net of cannibalization. Okay, so you can drag. As you know, you have the solution in the PDF, so you can check always. Huh? Same thing for the payable. So you have cost of goods sold time 15%. Okay, that could have been nice to take an assumption for the inventory. You can think about it in your group work. Also, be careful. Sometimes it's easy to make it 15% of sales, 15% of goods sold. But maybe here it could be interesting also to think about how many days it represents. Like for example, if you say this is divided by, 23.5, so that represents 15%. Of course, sorry, that was the original assumption. Times 365 days, so that's 55 days. Maybe you calculate the number of days it represents to check if it's coherent, because you sometimes every year in the group work, people sometimes they just do the percentage here, take the same, or but think about how much days it represents, how many days it represents, to check if it's coherent with the industry you're taking. So the working capital is inventory plus receivables minus payable. Okay. So just for your information, when we talk about the net working capital, we integrate cash requirements. When we don't, we talk about operating working capital. So operating working capital is inventory plus receivable minus payable. So I kept the assumption from the book that deals with net working capital, so you're not lost when you have a look at the book. And personally, I usually work with the operating working capital. But that's just a technical point, just for you to know, not very important. So we are finished with the the working capital. We can see it remains the same amount from one year to the other, which is a little bit theoretical as well, because maybe if you have changes in the quantity you sell or the selling price or whatever, it would change from one year to the other. So now we just do the increase in working capital. Okay, so this one minus this one. So you have an increase in year one. Then, of course, you have no change in year 2, 3, 4. And then you have a large decrease in year 5. Okay, so if you take this here, so minus the increase in working capital here, and I drag the formula, what does it show? It shows something which is very important for you to understand, which is the fact that we take into account only the increase in working capital, because you know that when there is an increase in the working capital, it will have a negative impact on your cash, right? Because if you have more inventories, if you have more receivables, then of course it's gonna be cash which is frozen in your operating activities. Okay, so it's not cash available for you. So for our project, what does it mean? It means that the fact that we have to create the working capital in year one will have a very negative impact on our cash for the company in year one. In year 2, 3, 4, there's no change, right? It remains the same. So, you know, you have the same receivables, but you receive the money from 60 days ago. And when you sell on credit, it's compensated by the fact that you received the money from 2 months ago. So it's like rolling, right? So there is no impact. And the last year, year 5 in our case, we have a positive amount of working capital. What does it mean? It means that you finished the project, you don't sell anymore, but you still keep on going, receiving money from the receivables. Okay, so there is a positive impact on your cash the year 5. Okay, because you recover the working capital. Sometimes people will consider it's at the end of year 4 that you recover. Sometimes year 5. You have to be careful about the assumption in the case. Okay, but we have also to consider the depreciation. Okay, so what happened to the depreciation? We add back, right? The depreciation. We add back the depreciation. Okay, because we subtracted it from the unlevered net income, but we add it back because depreciation is never cashed out. Okay, so we have to neutralize its impact on the cash flow. Okay, so we add back the depreciation. Okay, and for the capital expenditure, where we have only the 7.5 million here to consider. So we are finished with the free cash flow. So let me summarize those free cash flow. Okay, this one. So these are the cash flows of our project. So these cash flows of our project are the cash flows we're gonna discount now. You know what we did with the time value of money, C1, C2, C3, C4. This is, we have them now. We have them now. So we can calculate the present value and the net present value of our project. Okay, we cannot use shortcuts like constant annuity, whatever, because the cash flows are different. Okay, so we have to discount them one by one. Okay, but before going to that step, I would like to ask you in the chat if it's clear about the free cash flow calculation, or do you have any question? So in the chat now, I wait for your question about free cash flow calculation, what I just did. If you have any question, if it's clear, just, you know, say nothing or say it's okay, and we can move on. Okay, I'm quite optimistic because I see not so many questions. I was a little bit worried before the course because I was worried about the fact that maybe you don't remember very well financial statements and everything, but maybe you did the pre-reading or you read the book or you remember. So, so you can follow what we do here. So that's good. Okay, so no question. So we can move to the next step. Now we're going to compute the NPV. We're going to do it 2 ways. We're going to fill in the table 8.5, which is more like a manual calculation. And we're going to use a formula from Excel as well. Okay, now that following the advice of one of you guys, I changed my computer into English. So for the record, I had to restart my computer because I cannot change the language in Excel. I had to change my language for all the system in my computer. Okay, so so let's see how we can do this this table 8.5. Firstly, we need a discount rate. So we can see we have the discount rate, which is provided here, 12%. So this is a discount rate we're going to use. This is what we call the opportunity cost of capital, the project cost of capital. Okay, this is also an assumption you will have to consider. You will have to tell me with your group project how you reach 12%. Is it because you found this information for similar projects around? Is it because you calculated risk-free rate plus a risk premium or something like this? You have to explain to me how you do it, okay? But I will not be very picky on this one because this project cost of capital is also something you will study further with Pramwan Bunkanawisha in the course called Financial Structure and Strategies. So it's not my focus, but still you have to explain in a few words why you take such a rate. But we will see that what we call the sensitivity analysis, that we will try with several rates. So anyway, it's not so important. Okay, so what we do in this table 8.5, firstly, we just copy the free cash flow here. Okay, so these free cash flow are not discounted. Okay, then we're going to calculate the discount factor. So the discount factor is what? Is 1 divided by 1 plus R exponent the number of years. Okay, so for year 1, for example, it's going to be 1 divided by 1 plus the rate, okay, exponent the number of years. Okay, this is what we're gonna have. Okay, so that's a discount factor. Remember, it's when you take a cash flow and you just divide by 1 plus R and the number of years. This is what we do here. Okay, firstly, I'm gonna put some dollars around the cell of the discount rate so I can drag my formula. And as you can see, what I did also is that I took directly the n number of years, I took it here. So, you know, sometimes you could say, okay, this is 2020, oh, sorry, this is 2020, so this is 2021, and so on and so on. Maybe it can be interesting to, you know, to be clear, but for your project, could be interesting to say date 0, date 1, date 2, so you can use it directly in your formula here, okay? And you can drag the formula. Okay, so this is the discount factor that we find. Again, it's 1 divided by 1 plus 12% exponent the number of years. Okay, and how can we interpret this? Sometimes I try to do this exercise with people who are not finance people. You know, when I teach to, I don't know, sometimes let's say MBA or executive MBA or stuff like that, where people are very good professionals, but they don't have a lot of knowledge in finance. Sometimes I try to simplify this exercise, but try to do it with them. And when I reach the discount factor, I found a way to explain. I think it's quite convenient. I said to them, okay, what does it represent? It represents the value today of $1 in 1 year. Okay, $1 in 1 year is 89 cents today. $1 in 2 years is around 80 cents today. $1 in 3 years is $71 today. So it shows the what we call, I think it's correct in English because I think in French now, erosion, time erosion. Okay. The fact that, you know, with the time, money is losing value. So this is what we have here. And this is what we take into account when we take into account the discount factor. Okay. By the way, I can calculate it here as well. And it's going to be 1. Why? Because you know that 1 plus something exponent 0 is 1, right? So it means that the value of the cash flow today does not suffer from time erosion. Okay, so now I can just calculate my discounted cash flow. So that's discounted cash flow. Okay. Yeah. And so I can drag my formula. So that should be correct. And so the NPV of my project is the sum of my discounted cash flows. That is correct. Sorry. So do you agree? Did you follow? Do you agree? Is that okay for you? Do you have any question? Is that okay? Can I have at least an okay saying we still calculate year 5? Yes. Yes, of course, we calculate year 5 because we have a cash flow. So even if we have, okay, I think I understand your question. So yes, the project has 4 years, but what it means that there will be some sales during the 4 years. But if your project has consequences in year 5, such as increasing working capital or the last depreciation, we should consider that as well. Okay. So there is 4 years life. So it means that here we can see that we have no sales, but we still have consequences of our project in year 5. So it's incremental information. So yes, we have to calculate as well. So you give me the opportunity to say something I say sometimes as well, which is the fact that we usually have 3 big moments in a project like this when it comes to the cash flow. The year 0 is the moment you invest, blue stuff, the blue one, okay? Year 1 to 4 in yellow are the moment you produce and sell, okay? And the year 5, sometimes you can have, let's say, resolution of the project, the end of the project, okay? Maybe you can sell the machine, or maybe you can, I don't know, recover the working capital of it. You have sometimes the wrapping up of the project, the finishing of the project. So that can happen in year 5. Sometimes I must say, sometimes people will consider that in year 4 because they consider that we finish the project December of year 4. That's true too, okay? But in this case, in this scenario, in what they do in the book is we consider that we recover the working capital in year 5 because at the end of year 4, we still have some receivables, okay? And so these receivables will be paid in January, February, or March. So we consider that year 5, okay? And so globally, we can consider 3 moments in the project. The year 0, which is the moment we invest, the year where we produce and sell, 1 to 4 here, and the resolution year, year 5 to our project. Does it answer to your question? Okay, I'm happy, Dong. Do you have any question? Other question? Okay, so now we calculated the NPV of the project. Huh? So we finished what we wanted to do. We calculated the NPV of the project. Okay, so we got 10 minutes left. So I would like to share with you 2 things. Firstly, calculation the NPV using the formula from Excel. Okay, so you go in formula, and now it's going to be in English, so it's okay. I hope I will find the formula. I think it should be NPV. So the NPV, so it asks you for a rate, so I give the rate and the values. And here, sorry prof, I re-ask, do we need to provide calculation on cost of capital? Not, you can if you want, or you can just explain how you find the rate you use. Is it because you find a similar project with the same rate? Or is it because you found online a typical rate for an investment or something like this? Or you can do a calculation. So if some of you guys did that already in the past to calculate the WACC, for example, you can do it. Or you can take a risk-free rate plus a risk premium, okay? But then you have to justify how you find the risk premium, okay? Or you can say, you can try to find a similar cost of capital for similar project. So you can take a cost of capital from your company for previous project, okay, which are similar, or you can try to find similar projects with among the competitors, okay? So you have different ways to think about it. The first is just to try to find the information somewhere else, okay? And so it's not a question of calculation, it's a question of you explain to us how you found it. Is it because you found it like a similar rate for a previous project in your company or competition project? Or you can go for calculation. And if you go for calculation, you can do risk-free rate plus a risk premium, but then you have to search for a risk premium, okay, that is coherent with your industry. Or you can do what we call the WACC, which is weighted average cost of capital. If some of you guys did that already in the past, you can try to use it in our context, okay? But this is supposed to be studied in financial structure and strategy, so later on. Does it answer to your question, Thuy? Okay, you know, I will go into groups, right? When you are in breakout rooms, starting tomorrow after 1 hour to finish what we have to finish. I think we need 1 hour tomorrow, and then you go in breakout rooms for 2 hours and one more hour at least on Friday or Saturday, depending on if you are Hanoi or Ho Chi Minh City. And so what I do usually is that so I let you get organized in groups, I let you talk, and then I will go to see one group or the other. So you tell me what is a project you're planning to do, okay? And so I tell you, okay, yeah, I think you can do it, or be careful with this or that. I give you some advice, okay? And also it's time you share with me if you want some, you know, some questions about the cost of capital. You can show me what you do, what you did, and and sometimes also I don't want to know everything, because so I've got the surprise when you present also, okay? But you will be able to ask me questions. I will go into groups to make some coaching, right? To make some live consulting, okay? So I I lost the I don't know if you lost me. I did a mistake. I lost the chat. Okay, it's back. Okay. Okay, so I just would like to come back to the what we do together. Okay, so if you want to use the NPV formula from Excel, so you take NPV. So it asks you for a rate, so the rate is here. And for the value, yes, there is a mistake for me in Excel, because when you give the value to Excel, you must give the value from the year 1 to the year 5. Don't give the year 0, because the first value you give to Excel will be the first one that will be discounted by the rate, okay? So you cannot put the date 0 into your formula. So what you can do is, as I do now, you add the year 0 out of the formula, okay? So that means that this is the formula you have. So NPV go for using 12% for this 1, 2, 3, 4, 5 years, okay? So that will be discounted, plus the year 0 that will be out of the parentheses here, and should be okay. Yeah, it's okay. So you can see the formula here, and you have the NPV. Okay, so my advice is to do all the thing when you do your project, because it's good to, you know, I'm an accountant. I was firstly an accountant before being a corporate finance professor. I was CPA first. So I kept the good habit to sometimes when you calculate the things 2 different ways, just to be sure you find the same result, okay? And so this is it here. And so you're certain that the NPV is positive. Okay, for the NPV, any question for this formula? It's okay. So now IRR, so very simple. IRR, you don't have the problem of the data. You just take your data, 0 to 5, and this is it. So you have 24 for the IRR, okay? So just to make a little bit of a comment, you have a project, yes, you have a project which is interesting because it's positive NPV, and you have a IRR 24, which is higher than 12. So the IRR and the NPV, they go in the same direction. Okay, so we are finished with this. I don't know if you have any question, but this is what you must reach at least for your group work. And you can also do something else that we will discuss tomorrow. Okay, I come back to the slides. So you have some extra explanation if you want to read in the slides and everything. You find the things. Okay, so this part 8.3, choosing among alternatives. I always keep that in the slides, and it's been 5 years that I don't have the time to study that with the students. So same thing this year. We will not study that. So we go directly to further adjustment to the free cash flows. So what can we do? And this time, there are two things I would like to discuss with you. The first thing is that we can consider that sorry, can you share Excel file in Canvas? No, no, I will not. I will not share HomeNet case in Canvas because I want you to build this one by yourself. So this one I will not share. Okay, I'm sorry, but I think it's part of your learning process to be able to make it yourself. So this one I will not. I'm sorry. Yeah. Okay, so just to finish with this, yes. So I would like to discuss 3 more things with you tomorrow. The first is that what happens is if we sell. Sorry, so I'm not going to show you this. Yeah. So I would like you to try to do this for tomorrow. Let's consider that the HomeNet project can be sold at the end of year 4 for $2,000. What would be the new NPV of the project? Okay, so I would like to try to do this. And the new NPV is 55829. Okay, so I'm hiding it now. So I would like you to try to do it. And you should find, sorry, it didn't work. Yeah, 5829. Okay, so please try to imagine if you sell, instead of letting the depreciation happen year 5, what happens if you sell the machine at the end of year 4 for $2,000? So you will receive $2,000, but you will also have to pay some taxes on your gain, right? So you have to calculate the remaining book value of the asset, to calculate the gain, the tax that you will have to pay on the gain, and so you can calculate the NPV. Okay, so that's one of the 3 things we will study tomorrow. We will study this. We will talk about terminal value as a growing perpetuity. Then we will talk about sensitivity analysis and scenarios. And so I think after 1 hour, we will be done, and we will work, you will work in groups. So you will have 2 hours to work in groups tomorrow, and I think 1 extra hour on Friday morning or Saturday morning to finish. And so the 2 last hours of Friday or Saturday will be for presentations. So we will have, 4 groups, 2 hours, maybe with a break, 1:45. So I think we are exactly in the same timing than previous years, huh? So we are exactly on time. So yes, so you prepare that for tomorrow, to try to answer to this question. We begin with this. We see 2 or 3 more things. I re-explain the group work rules showing the document, and then you will work in rooms, and I will go and visit you in the different rooms to see how it goes. Okay, is that okay for everyone? Because it's 10 p.m. now, so I think it's quite late for you now. I think you you certainly would like to rest a little bit. Yes, I will enjoy the snow. Maybe I will take a picture and share with you. And so enjoy your evening, and see you tomorrow at 7, and try to do this little exercise. Okay, bye-bye.